As widely anticipated, Federal Reserve has decided to keep the policy rate unchanged in its December meet post the three rate cuts we've seen earlier. Let's do a three-point analysis to understand what this means for emerging markets such as India. 1. Key highlights of the US Fed announcements. Well, Fed chose to pause rate cuts and mentioned that federal funds rate policy would also remain at current level unless there was a material change to the economic outlook. Now, Fed's commentary for the state of US economy largely remains similar to what has been the premises of the last three rate cuts. Now, strong labor market, improving household spending, but weakness in the investments and exports have been seen. However, dovish commentary by the Fed chair, Jerome Powell, during the press conference also dragged the US dollar downwards. Sluggish growth abroad, trade developments and muted inflation have been a key risk to the US domestic growth outlook. Now, projections for GDP and inflation were steady, while that of unemployment was further tweaked downwards, reflecting on the recent strong labor market numbers. 2. Justification for a status quo. Well, policy rate changes act with a lag. In case of current cycle of policy rate, stance remains that positive impact on the economy, particularly to the interest rate sensitive sectors, would happen with a time lag. Now, similarly, any trade deal, even if successful, would have a material impact on the global economy with a lag. These two factors would help inflation edge towards the 2% target level gradually. So by reiterating this narrative, Fed is actually reaffirming that rates are expected to remain lower for longer. As per CME Fed Watch tool, market expects a higher probability of a status quo in policy rates throughout the year 2020. Overall, by choosing for a status quo, Fed is essentially saying that let us wait and watch out for the recent rate cuts to really play out, along with any developments on the trade negotiation front, and hence wait particularly on inflation. 3. What's the outlook going forward? Well, before considering resumption of the rate hike cycle, Fed would look for a significant increase in inflation, which also persists for a considerable time period. That is a scenario when inflation overshoots the target of 2% and stays there. Also, there should be sustained reduction in the trade tensions, which aids the business sentiments. Fed believes that the resumption of business activities would also feed into inflation with a lag. Now, this means that Fed is not at all in a hurry, even if phase 1 of the US-China trade deal happens as expected and there is a dramatic positive change in the geopolitical situation as well. Fed also wants to rule out any kind of structural disinflationary trend before acting upon. These points suggest that threshold set by Federal Reserve for the rate hike is sufficiently higher. Thus, Powell's narrative for lower for longer continues to be an extended accommodative period, which could be a positive for emerging market assets from currencies to equities in our view.